This is the Invest Like a Billionaire podcast, where we uncover the alternative investments and strategies that billionaires use to grow wealth. The tools and tactics you'll learn from this podcast will make you a better investor and help you build legacy wealth. Join us as we dive into the world of alternative investments, uncover strategies of the ultra wealthy, discuss economics, and interview successful investors. Welcome back to the Invest Like a Billionaire podcast. I am your co-host, Ben Frazier, joined by co-host
Bob Frazier.
And this episode, we are going to be diving into the world of hedge funds, right? So we're in a series right now where we are covering the big three alternative investments. We've already covered real estate, then we did private equity last episode, and now we're doing the final one, which is hedge funds.
The mystery, the black box. What the heck is a hedge fund?
So this is probably one that's least understood by most kind of individual investors. What's pretty cool is your background. You actually ran a hedge fund for a period of time before Aspen. And so you have kind of a great perspective on just what the landscape is like. And obviously there's a lot of movies about hedge funds. There's a lot of, headline billionaires from hedge funds. So people know that it can be a great strategy, but how's the performance and what is the really role of it in a portfolio? And so that's what we want to break down today. Is this, in these series of just, broad stroke overviews, we really want to hit on what are the definitions, what are the strategies, what are the structures, and how do you invest in these, and how should you think about these? So, on the alternative investment continuum, which we've talked about in a lot of episodes, this is level 4. So we kind of have, as you get more sophisticated, as you have a higher net worth, but we see most investors kind of going up this continuum, which is, starting with the stocks, bonds, and mutual funds, going to level 2 of real estate, then some private equity and hedge funds. And so, again, we've talked a lot about in other past episodes of how the ultra wealthy are investing. Hedge funds is a portion of that. So it's usually a smaller portion, at least in recent years. It's still something that the ultra wealthy, the billionaires are looking at as a good place to get volatility protection as well as diversification and return. So,
and in general, the larger the investor
Yes.
and the more sophisticated, the more they like hedge funds.
Yeah.
So we want to pull back and look at the mystery, see what the major strategies they're using, what the advantages, and like that. So, what is a hedge fund? Well, a hedge fund is basically pretty much you can do anything you want, and so that's the whole point about a hedge fund. And so they'll do long equities, which is buying stocks. They'll short, which is individual investors rarely do that. So they actually make money when a stock goes down.
Yep.
And do things like swaps, interest rate swaps, currency swaps, stock swaps, credit default swaps, which are very complicated derivative instruments, commodities. Everything goes. And so it's very sophisticated. Some of the smartest people in the financial world work for hedge funds, and some of the smartest mathematicians. So let's take a look at this a little bit as we dive in. So the average hedge fund in 2020 returned 11.6%, but the S&P 500 gained 16%. So actually the hedge fund, the smart guys, did worse. And
Right.
So wait a minute. So
Is that over the past 10 years?
that
was
was just 2020.
Just 2020.
So since 1994 to 2021, through both bull and bear markets, the passive S&P 500 index outperformed every major hedge fund by over 2.5%.
Yes.
So the hedge fund, the hedgies are basically getting creamed by the plain vanilla investors.
And there's kind of always been this argument of active versus passive investment in the public markets, right? Of, well, I'm just going to invest passively in an index. And so these hedge funds, they have to justify, because they're charging fees, right? Generally higher than a passive mutual fund or an index fund. And so they have to justify those fees by getting better performance. But in the recent years, they haven't been able to do that.
So maybe you're ready to tune out now, but please listen, because there's a reason that's not. That's irrelevant.
Exactly.
And so look at this chart here. So this shows during the decade of the 1970s, 80s, 90s, 2000s, and 2010s, really how hedge funds performed relative to the broader market. And you can see during the 70s, 80s, and 90s, hedge funds did very well or slightly better. And then in the decade of the 2000s, hedge funds massively outperformed the market. And then the next decade massively underperformed the market. But what I want to point out, well, the decade of the 2000s, you had both the dot-com crash and you had the 2008 crash.
Yes.
So when equities are likely to crash, the hedge funds did very much better. On the other hand, since 2010, well, we've had pretty much a one-way bull market that's been going one way straight up. Well, hedge funds have underperformed that. Right. And that actually gives a lot of insight into how hedge funds work and when it makes sense to invest in hedge funds. So here's the saying, is that hedge funds deliver equity-like returns with bond-like volatility. The idea is to get close to equity returns, but at far less risk and far less volatility than the stock market. And in fact, that's been largely true throughout the 1980s, 1990s. So, and as we go into the strategies, you'll see why it's like this. And so in today's market, it may make sense to start looking at hedge funds again. So hedge funds have been declining in popularity during the last 3 years, generally, because of this. Because, hey, when the stock market is going up so much, why not just put it in the S&P 500? And it's hard to compete with that.
Right.
But if the stock market is in fact overvalued, I've seen arguments both ways, and clearly it actually is on a fundamental basis overvalued. Sure. But that's not to say it's not going to continue to be overvalued.
Right.
Okay. But if it is, and in fact it is ready to be volatile, then you want to look at hedge funds because they outperform.
And this kind of goes back to the concept of risk-adjusted returns, right? We've talked about in other podcasts where you can have two similar opportunities of investment that produce around the same return, but one has significantly more volatility, which is the proxy for risk relative to the other. Well, you're going to want the one that's going to have less volatility. And the stock market historically has had a lot of volatility. And especially later on in a market cycle, it can increase. And so what you're saying is the hedge funds look to achieve an equity-like return, so a good double-digit return that you'd see in a bull market, but without a lot of
far less risk,
a lot of the risk.
And so there's a lot to be said for that. So are you willing to give up some of the return in order to avoid a lot of the downside?
Yep.
And so if that's what you want to do, then hedge funds are definitely something you should be looking at. So the top performing hedge funds in 2020 were energy and basic materials funds, technology-focused funds, and healthcare funds. Now, and in good years, hedge funds can return 50% returns and better. I was just looking at the last over top performing funds, and over the last 3 years, there's many that are over 35 to 40% returns, and there was one that even that it was returning around 40% per year for the last 3 years, and only had 5% churn in their portfolio on a quarterly basis, meaning they're only changing their investments 5% quarter, which is insane.
Which is very low for a hedge fund.
Yeah. So now that's probably blowing your cork a little bit, and as it should. So who is doing this? Well, typically the stars. There's the star phenomenon in hedge funds. So whenever a hedge fund has a good year, a lot of times that star will go and start their own fund. And if you saw the movie The Big Short, there's hedge fund guys that made their hay by making the call. Little tiny guys that were stars made this incredible call, got super wealthy on that. Well, now attracts a large amount of investors. So there's a star phenomenon that this really is. There's certain people that really have the goods it takes to do this, and other people that just don't.
So if you're looking at like a broad average of hedge fund returns, that may be misleading if you break it down by quartile or quintile, or just looking at the top performers. It's the variance is very, very big in the types of returns you're going to get across.
And if you look at every hedge fund, they'll tell you who their fund manager is.
Right.
So there's a celebrity. This is the guy you want to invest with, and there's reason to do that.
Yeah.
So let's look at the structure. How does a hedge fund generally work? Well, they're all fairly similar. Actually, you find very little variance on this. So it's called the 2 and 20, and the idea is they take 2% of the assets under management. So every year, in order for managing it. So if there's $1 million in assets, they'll take $20,000 a year off the top. and then 20% of profits. So they only make that if they're making money. So if there's no profits, they don't get that. So they're highly incentivized to make profits. So that's pretty much the way it works. It's generally a general/limited partner. So the manager is the general partner. The investor is a limited partner, means you don't have any say in the investments. It's very passive from your perspective. These managers are actively managing, so they're actually trading their portfolios, buying the swaps, buying the stocks and the shorts, etc. And the goal is to generate above average returns. And a lot of times these are 6 to 7 figure minimums. So especially the bigger funds, it's 7 figure minimums. So so you got to pay to play. And most important thing in evaluating these is track record. Those are the top 3.
Yeah, I was talking with a broker who helps place money in hedge funds of the day, and everyone's heard the idiom in real estate that the most important thing is location, right? It's all about location in real estate, and he said the same thing in hedge funds. It's all about track record, right? It ultimately comes down to they live and die by their performance, right? And they're all looking to generate alpha, which is basically above market returns, above their benchmark. And so that's what every hedge fund's goal is. And the interesting thing too, let's make a quick kind of compare and contrast here, is in the other two alternative categories we've talked about in private equity and private real estate, this one stands out because it is in the public markets.
Yes.
Right. And so that is a very big differentiator here. But the way that they're building these portfolios and these strategies and doing hedging can limit the volatility, which is really one of the main reasons you go to the private market. So you kind of get some of that in the public markets here. And so it does provide some of the benefits you would get in private, but obviously they're using publicly traded investment tools to do these portfolios.
Okay, so let's look at the 7 main strategies that are used. And I'll just say these are 7 very big buckets that these strategies can be so diverse and so unique and so different. Here's 7 big strategies. And number 1 is the long short equity strategy. So 75% of all hedge funds fall into this category. And it's basically they're picking stocks and with some shorts. So, they'll go long Apple, long, there's some real popular ones, long Google, long some of these techs. And so this is the strategy, and including some short positions. So they may short a couple stocks that they think are overvalued. Now right there, it tells you why is this equity-like returns with less volatility. As soon as you have a short, as soon as you're shorting a stock, you're making money if that stock goes down. But if all stocks are going up as they are right now, pretty much, well, then your returns are going to be lower.
Yeah.
Right. Because you've got some that aren't. You've got some that
your
short
making, position is losing
money. Yeah. So if you're making money when it's going down, if it's going up, you're losing money, and so that's why. But also, if there is a correction, they will make money in those. So it's inversely correlated. So that is the number 1 strategy. And of course, not all stock pickers are the same. Some of these guys, some of these stars are doing this. And of course, if you really are a true, savant and a true star, what you will do is you'll go start your own hedge fund.
Right.
So that's what these do. If you want to find a star, they're not going to sit and work for, a fixed wage somewhere. They want to make millions or even billions of dollars. And so they'll go start their own fund based on their skill set. So there are a lot of stars out there, and the pickers really matter. So that's the number 1 strategy. The second strategy is a market neutral strategy, and what that is the idea is that let's say is to have 0 broad market exposure. So the idea is, if you believe in Apple and you think Google is way overvalued, or let's just pick Netflix. Netflix is way overvalued relative to what it's actually producing, and Apple is actually a great investment. You take for every $1 you invest in Apple, you short $1 of Netflix. And so the idea is, if the stock market goes up, presumably both will go up and down. And so it's actually neutral relative to the overall performance of the stock market. What you're playing is the idea that Apple's going to overperform and Netflix is going to underperform. So that's a market neutral strategy. Now, of course, everything's going up, but that's not going to perform well.
Right.
But if the market is very choppy or going down, these can do very, very well. leaves market neutral. And presumably, again, superstar that's kind of making these calls and generally might be pretty good at what they do.
And going back to the data that we showed earlier in the 2000s, right, where hedge funds were actually positive and very positive while the broader indexes were negative, and that was a lot to do with some of these hedges or these other positions that they took that actually performed well when they're going down. So it's
right. So now we get into a whole bunch of arbitrage and quantitative strategies, and this is where the best mathematicians in the world are coming in, and arbitrage. And arbitrage is basically the way to play minute differences in different investments. Right. So, who was the guy who just wrote the Flash Boys? Was that
Michael
Lewis? And they're arbitraging the difference between literally the stock trading in Chicago versus the stock trading in New York. Same stock is trading pennies in difference. So they're buying one and selling the other, than buying the other and selling the one, and making pennies. And so that's the idea of arbitrage, but there's lots of different kinds of arbitrage. There's merger arbitrage. So you're arbitraging when a company's ready to buy another company, the differences in those stocks. There's convertible arbitrage, capital structure arbitrage. So, for example, a lot of companies offer stock, of course, and they also offer bonds. Well, you can get in situations where the bonds are underpriced relative to the stock. You go long the bonds and short the stock, right, or the other way around. So very, very common, called capital structure arbitrage. There's fixed income arbitrage. So this is where you're long or short bonds relative to treasuries, and you're playing differences in interest rates. And some of the greatest successes and failures have been in quantitative strategy. Some of the greatest mathematicians and in these kind of strategies. There is event driven. This is roughly 10% of hedge funds operate in the event driven space, which is things like mergers, restructuring, shareholder buybacks, debt exchanges, security issuance, or other capital events. So they're playing an event. They're getting ahead of this event, and they're placing their bets and then post-event collecting on those events. So those are very popular as well, event-driven. And again, they don't have necessarily the same level of long or short exposure, pure long-only investment. The fifth here is global macro. This was what my hedge fund was. And this is where you look at economics and you invest based on what you think are economic realities. For example, the emergence of China, or the fact that Chinese currency may be overvalued, this kind of thing. I had a strategy basically long the Swiss franc and short the euro, and you turned out to be very, very right one instant in time. So based on economic realities, right, you invest in those. Basically, you make money when you're right based on global economic trends. The sixth strategy is short only. So this is one, if you're an Uber bear, what they call perma bears, right? Right. You want to invest in this, and these guys make money when the stocks go down. Shorting is not understood by all investors. Shorting is basically when you borrow a stock. So let's say Ben owns Apple, and I believe Apple's a bad investment. I believe it's going to go down. Well, I'll borrow his shares. So I'll borrow 100 shares of Apple. I will sell those. I'll get cash when I do that. Now, if Apple actually falls, well, then I buy those shares back some point later using my cash, but now less cash than I sold them for, and I'll actually return his 100 shares back to him. Right. And so that's the mechanics of how shorting works. Well, there's short only strategies if you're a bear. Obviously, in a market like this, that's going to be really tough to make money in short only.
Right. And I also think of activist investors a lot of times too, right? There's like the hedge fund billionaires, like a Bill Ackman or somebody who targets a company, basically determines that these guys are a fraud.
Muddy Waters.
And or Herbalife was another one I remember he was trying to take down. So he would go and publish this, really extensive research and basically try to convince everybody that this was a scam, right? And so he'd take a big short position and try to get the market to agree to his
So they go. So it's a lot of research. They go try and find a dirty company or an overvalued company or something with all this hidden dirt under the surface. Right. And they'll go basically accumulate, borrow a bunch of shares over a long period of time of this, and they'll go borrow those and sell them. And then they go publish their dirt. Right. They go stir up the dirt and muckrake and And when that thing falls, then they collect it all. So
right,
seems like kind of an ugly business.
Yeah, you probably when they are not successful, and it's the other challenge too, and we've seen this research where, I mean, the stock market generally goes up most of the time, right? I think it's 70% of the time it's going up. So you're really at a disadvantage from just a natural tide in this strategy. So it has to be really idiosyncratic of a specific company or a specific sector for a short period of time for this to be successful. So it's it takes a lot of cahoots to go do this well, but it's there are investors that are successful in that.
Yeah. So, and the seventh strategy is fund of funds. And the fund of funds is generally where you have a manager who is investing in other hedge funds.
Right.
And so this gets a bad rap because, typically the numbers say they underperform because you're adding another layer of fees, right? You're adding generally another 1.5% of AUM fee and another 10% of,
right.
So it's like fee on top of fee. But I actually think it's a good strategy because what they could do is they're finding that who are the best up and coming stars, who are and also they can rotate strategies quickly based on macroeconomic realities, etc. So I think it deserves a look, especially for investors that want to get in hedge funds but aren't as sophisticated as they would like to be and want to get in but let someone else manage the portfolios.
And because to your point earlier, a lot of these minimums for these investor or these hedge funds are very high. So if it's a 6 or 7 figure minimum, but you want to get exposure to multiple strategies, a fund of funds is a great way to go because you can put in a smaller dollar amount. A lot of times they have what's called access funds where they will actually lower the minimum. They negotiate with the operator, hey, we can bring a lot of capital if but we can lower our minimum to our investors, but we're going to invest a big dollar.
So it might be a good entry point. In fact, a lot of the fund of funds are actually smaller than the hedge funds themselves. This is what you wouldn't think about. So far less money is in these, and they're generally smaller funds with, as you said, smaller minimums. So I think, especially if you wanted to get into it, this is a decent way to take a look. The other way, there's actually a number of ETFs that actually invest in hedge funds, and so you can look those up on ETFDB or other resources and see if you want a poor man's approach to dipping your toe in hedge funds. But so as you can see from our strategies, they're going to be a lot of smart guys. If you believe the market is just going up, you really need a reason to invest in hedge funds. It's just not going to be is good. Most the reason the institutional investors and the large investors invest in hedge funds is diversification. That's the number one reason, to get good returns but reduce risk dramatically and diversify from the market. So you want to have uncorrelated or negatively correlated assets. And if you do, well, that reduces your overall risk, but it also reduces your overall return potentially.
And break down real quick what a perfect correlation is or a 1-to-1 correlation is.
So 1-to-1 correlation means if the general stock market goes up $1, your portfolio went up $1.
Right.
A -1 correlation means if the stock market went up $1, you lost $1.
Right.
Okay, so that's a -1 correlation. You have positive and negative correlations. A 0 correlation means you didn't lose or gain.
Right.
So you're in cash. It's under. A correlation
mattress.
of 0 is when you stuffed your cash in the mattress, and the stock, you have a correlation of 0.
Yeah.
And so what happened? We say correlations go to 1. It's pretty much all investors went the same direction, and they, everything went up or everything went down at exactly the same time. And it's horrible for someone who's trying to get diversification. So if your market outlook is bullish, you need a specific reason to invest in hedge funds. So generally they will underperform, but they have various different levels of correlation. So if you can look at this chart from Investopedia, I love this, and it shows here's basically of the big strategies that we outlined, how they correlate to the general market. And the long short is going to be most correlated to the market, of course, because they're pretty much in the stock market with a few shorts. Yep. So you can see all the way down to dedicated short has a negative correlation to the market. So this is a good little chart to get you started on thinking about how do I want to diversify my portfolio. Most academic studies out there actually show that hedge funds are on average far less volatile than the stock market, and you can look up some of those realities yourself. So how do you find these best hedge funds, and how do you do the due diligence? Well, most of them are very black boxy. Most of them are very secretive about what they do. Start to have some conversations. There's a website called Hedge Follow. You can see some of the top performing funds in the last year, the last 3 years. But here's some of the questions you want to ask. Who are the founders and principals? What are their backgrounds and credentials? One of my favorite things is to look at some of the decks that their theses decks. These are some of the smartest guys on the planet. So I think Double Line is one of my favorites, and they're hedge fund managers, and they publish a deck quarterly of kind of their investment theses. Kyle Bass is another one with I can't remember the name of his fund, but these guys are super smart, and if nothing else, they will make you think and challenge your presumptions. I like to read a lot of this stuff, and then kind of the balance comes out, or the truth comes out when you hear all these different opinions, and you read the data yourself. But they're super smart. So that's a way to kind of get to know their thesis, know their investment staff, and what they think is going to happen. You want to look how long they've been in business, what their track record is. You want to look at their ownership structure. You want to look at their fee structure. You want to understand their basic investment strategy, and usually that'll come out in the PPM and the pitch decks. And then you want to look at just how often are valuations performed. Again, these are public markets, generally with publicly traded securities, so they're typically valued every quarter. In fact, they have to report, the bigger ones have to report to the SEC every quarter. And then what are the lockup periods? What are the liquidity provisions? So kind of again, in summary, hedge funds are probably the domain of the most sophisticated and the most wealthy investors, for good reason, because they get really, really good returns at far less risk than the just being long only. Very star based, very, very much based on a personality, a celebrity, a superstar, and usually it's well deserved, and a lot of different strategies. So if you like investing, you like research, you learn so much by just reading about what these guys are doing, talking to them, etc. So really, and I think in today's timing, I think it makes a lot of sense, to look at these hedge funds, because with the market at these levels, I believe that there's a lot of risk, a lot of downside risk. Personally, I believe because of the incredible amount of liquidity, we're probably going to continue to rise. The stock market is probably going to continue to rise, but it's going to be increased volatility because the valuations are so high right now. So, but hedge funds are probably a really good choice at this time.
Yeah, and we've published some of that economic research where we basically kind of give our sentiment of where we think the stock market is going, but expect choppy waters ahead just at this part of the economic cycle, and just given where the valuations are. So it is something to consider, and we have a few guests already identified that we're going to be bringing on that are kind of experts in this kind of arena, and I'm really excited to talk with them and break it down a little bit more and understand how does kind of an individual investor get more access to these types of investments, and what are the kind of process of evaluating, when that's a good time and all that. But hopefully this was really helpful, and it's kind of breaking down what this kind of mysterious world of hedge funds really is. And thanks so much for joining, and stay tuned for some more great episodes coming up.
See you next time.